Why is the US pulling so much gold back from overseas vaults right now? If you're wondering why this is happening and how it could affect your investments, you're in the right place. What might seem like just another move in the financial markets could actually be part of a much bigger trend that could change the way we think about gold and potentially reshape the global financial system. So, here's the situation. Traders have been moving nearly 400 metric tons of gold from London to New York, and it's pushing COMEX inventories to levels we haven't seen since 2022. To be precise, COMEX gold stockpiles have increased by a staggering 75%, reaching 926 tons. That's the highest level we've seen since August 2022. Now you might be thinking, okay, that's a lot of gold, but why is it important for me? Well, here's the kicker. This isn't just some temporary spike or a routine shift, it's part of a much bigger, long-term trend that's reshaping the way investors and nations view gold. Now, you might be asking, is this just an arbitrage trade or is there something deeper going on? The answer, it's not just about making quick profits. What's really happening is a massive shift in global gold flows, driven by a surge in demand that's putting the entire system under pressure. And no, this isn't some random blip on the radar. It's a warning sign that could have serious consequences for the global financial system. If you're following along, you're probably aware of the term supply chain bottleneck. It's been all over the news lately, from food shortages to tech delays. But when it comes to gold, it's not just a simple shipping delay. The Financial Times and other major outlets have been quick to call this a supply chain issue. Yes, there's gold moving around quickly, and yes, the system is struggling to keep up. But here's the thing, this isn't a sign that gold is running out, it's a sign that demand is so high that the infrastructure for moving physical gold just can't keep up. And that's a big deal. Here's a perfect example of how strained things are. Bank of England withdrawal times have gone from just a few days to 4 to 8 weeks. That's not because the vaults are empty. Oh no, it's because the sheer volume of requests is overwhelming the system. Moving gold isn't like running to the store to pick up a loaf of bread. It's a complex process that involves processing, transportation, and reallocation. And trust me, when demand spikes like this, it takes time. And then there's the matter of leasing costs. They've jumped from 0.5% to 12%. To put it simply, when it gets more expensive to lease gold, it's a signal that the market is under serious strain. If the market were stable, leasing costs would be much lower. But right now, that spike in costs is a clear indication that the system is stretched thin. It's like trying to fit a week's worth of groceries into a backpack that's way too small. Something's gotta give. Now here's the crazy part. Did you know that gold bars in London and New York aren't even the same size? London uses 400-ounce bars, while New York's COMEX only accepts 100-ounce or 3-kilo bars. So when gold moves from London to New York, it often has to go to Switzerland for resizing. This extra step adds a huge layer of complexity and delays, further tightening liquidity in London and creating even more strain on the market. But hold on, let's switch gears for a second. You've probably heard about China's increasing demand for gold, and it's a big player in this game. Back in August 2023, we saw the emergence of something called the China Premium, where gold prices in China were trading $60 higher per ounce than in London. That's a big deal. And by October 2023, reports showed that China wasn't just waiting for deliveries from London anymore. They were getting their gold straight from New York. In fact, U.S. bullion banks were even caught facilitating direct shipments of gold to China. But here's the twist. By November 2023, demand from the U.S. has surpassed China's. Yep, you heard me right. The U.S. is now the largest buyer of gold, with 393 metric tons of gold moved into COMEX vaults since the November 2024 election. This shift is monumental, and it signals a dramatic change in how investors are thinking about gold. The data shows a two-stage spike in New York gold stockpiles, one during the pandemic in 2020, and the other starting in January 2024, and accelerating since then. This isn't just a quick trade, this is a long-term trend that's only gaining steam. While the London Bullion Market Association continues to reassure the market that London's gold reserves remain stable, we're seeing a different story on the ground. The truth is, the demand is so high that it's putting a serious strain on the system. Bank of England withdrawal times have skyrocketed from just a few days to 4 to 8 weeks, signaling that, while the LBMA may offer reassurances, there's a real challenge in moving gold quickly enough to meet rising demand. Now, while all this is going on with gold, let's not forget about silver. I know gold gets all the attention, but silver is moving in similar patterns. Did you know that 80% of the silver used in U.S. bullion manufacturing comes from international sources, mainly from Mexico? And with tighter supply chains looming, a silver squeeze could be coming sooner than you think. According to Bank of America, a 1% shift in global reserves into silver could send prices skyrocketing. The silver market is valued at around $30 billion, but global foreign exchange reserves are over $15 trillion. Shifting just 1% of that into silver would be equivalent to 5 years' worth of supply. That's big potential if you're thinking of diversifying into silver. Now let's get back to the big question. Why is the U.S. pulling so much gold back home? It's not just about market movements or tariffs. This gold repatriation trend is happening globally. Germany started bringing its gold back in 2016 after some delays. China and India have been steadily increasing their gold reserves for years. And now, the U.S. is following suit with an unprecedented rate of repatriation since 2023. But why? Well, there's a lot to unpack here, and part of it is tied to rising geopolitical tensions, shifting trade policies, and financial institutions wanting to hold physical gold rather than relying on paper claims. In fact, some of the world's most influential financial figures have been vocal about the growing importance of gold in today's economic climate. Ray Dalio, the founder of Bridgewater Associates, has long been an advocate for holding gold as a hedge against inflation and currency devaluation. Paul Tudor Jones, another legendary investor, has also been outspoken about gold's role in safeguarding wealth amidst increasing financial uncertainty. These institutional voices are aligning with what's happening in the markets right now. Gold is not just a commodity, it's a pillar of financial security. But let's not forget about London's gold market, which is highly leveraged. Only 36 million ounces of gold are available for immediate trading in London, while vaults claim to hold 279 million ounces. That's a major red flag, and it's one of the reasons why gold prices are surging. The system just can't handle the demand when it's stretched so thin. So, here's a thought. Could a standardized global gold bar system fix this mess? Maybe. But here's the problem. Traders love arbitrage. They love making money from price discrepancies. And as long as there's money to be made, there's no incentive to change the system. And what about tariffs? Sure, tariffs have played a role in pushing gold into U.S. vaults, but they're not the full story. There's more going on here. You've got Basel III regulations making it less attractive for financial institutions to hold unallocated gold. And then there's the ongoing uncertainty surrounding fiat currencies. When inflation is high, geopolitical risks are rising, and financial systems are under pressure, people naturally turn to gold for security. But here's where it gets interesting. ETFs like the Spider Gold Shares ETF, also known as GLD, are still a major player in the gold market. While ETFs give investors exposure to gold without needing to hold physical metal, the massive movement of physical gold into COMEX vaults suggests that institutional investors are losing faith in these paper claims and seeking out the real thing. This is an important shift, as it signals a desire for tangible hard assets as a hedge against potential market instability. So what does all this mean for you as an investor? It means that physical gold ownership is more important than ever. If you're still holding gold on paper or in a bank's name, you might want to reconsider. As global uncertainty grows, gold is the safe haven that investors are flocking to, and if you want to protect your wealth, you need to have real physical gold in your hands, not just paper claims. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide. Now, if you're tired of these so-called stock market experts blabbing about the same picks over and over again, I've got good news. I found an investing newsletter that completely blows the competition out of the water. They find highly asymmetric stocks with low risk and high reward, the kind you'll never hear about on CNBC or other major stock market news sites. I'm talking about companies like Ukrainian agri-producers during a war, or Bank Handlowy in Poland, a solid bank trading at insanely low valuations. These companies aren't flashy. Many of them produce boring products or provide services in oil and gas, banking, and agriculture. But here's the thing, they make money. And by investing in stocks like these, you can too. For a limited time, they're offering a 30-day trial for just $1. But as a thank you for watching this video to the end, I can do even better. Click the link in the description and tell me your best email address so I can send you their recent newsletter for free. It comes with 5 stock recommendations as well as high-quality market analysis, so make sure you check it out. You've literally got nothing to lose.